Let's talk some trading, volatility, and the macro framework of Mr. Cem Karsan back with us for the monthly update. He's a senior managing partner at Kai Volatility Advisors. Cem, welcome back.
Great to be here. Always fun.
All right, three main points in your framework from the last few times we've talked about, starting with kind of the most macro. Your view that we get back to 5% in the 10-year by the end of the year. Seems like we're on our way there. Feb to March Opex being the most probable for a crash, and then structural pickup in vol. We're getting that vol up, stocks up, but let's start with the window of weakness here. I mean, this looks like anything other than weakness to me.
Yeah, to be clear, it's never easy. If everybody thinks that it's just going to play some script again and again and it's going to be that straightforward, that's not how these things work. I want to reiterate that, during COVID, we knew about COVID. Everybody attributes that big 30% gap in 1 month to that big macro event, and clearly that was the main factor. But we knew about that late December, early January. What happened? Everybody was talking about it. Everybody was preparing for it. People were shorting it. What we saw under the hood was market up, vol up, market up, vol up, and the market went straight up until the day after Feb Opex, right? Frustrated everybody. Everybody started throwing in the towel. And then you got a 30% decline.
Yeah.
Now, I'm not saying we're going to follow that script again. I'm out here talking about it. It's not going to be that easy. But the point here is, think about 1999. I started this business in 1998. What did we see then? We saw market up, vol up for almost a year.
Yeah.
Everybody knew a top was coming, that 42 PE, all the stuff was crazy. But people were prepared for it reflexively. What that meant is that it was not going to be easy and that we're going to squeeze at the end. The trade at the end, the easier trade, and I've tried to hammer on that in here, is to buy upside vol longer dated when this starts to happen. Because in this situation, people are getting short, people are selling calls against their positions, and what that leads is more fuel to that vol fire into the squeeze up.
Right.
And you need to unpin vol to get this blowout top. You need to see vol go up for a while. We're starting to see it. We've seen it for almost a month here.
Look, I know you look at fixed strike vol. Me, a layman, I look at the VIX. VIX has been going up since December while the market's going up. This period here that you described as the highest probability of weakness. We didn't get that Jan window to open up to the downside, and so we kept rallying. You talked about the possibility of the Valentine's Day massacre. So is that over, or are we still in that window of weakness?
I've said this before. Instead of playing in two dimensions, try and think about these calls, which are very cheap, out of the money, you can sell stock against. Mm-hmm. That is you own a left tail massively if that happens. Those calls disappear, you're short stock into a decline. The way to play this, I've been very clear. I've given you guys the trade. Long dated calls, short stock.
Right.
Into a rally, if vol goes up, you're making money into that rally, long vol. And then if you decline in any meaningful way, which eventually will come, by the way, it will come, right? You'll get a profit on the downside. It's the best risk reward by far. You don't need to be short the market or long the market. Play the best probability odds. And that's what we've been preaching. Vol up, market up continues to happen. It will continue to happen in this market if we squeeze any higher.
Today we're trying to squeeze the Russell, and to your point, each time we've had these conversations, even when you do see the window of weakness, you have been clear that until it's obvious to develop, you don't start going directly short. You maybe try to dabble or fade, but have you been surprised by how the AI stuff has maybe outweighed some of these vol principles? Is that what's happening at all? This rush, this gold rush?
Again, 26 years of doing this, nothing surprises me anymore. I lived through the tech bubble. I lived through 2008. We were the biggest market maker in the S&P 500 during the great financial crisis. Crazy stuff happens, and it always goes further than you think. The markets are a reflexive machine. By definition, it's always going to be difficult because people are rationally betting against things when they don't make sense. CPI up into a declining market. 65% of commercial real estate is underwater, right? We have issues. There are big structural issues. The problem is this thing will not go down until people start throwing in the towel. And what it'll do is it'll go up faster and faster. It'll squeeze out people till it's so painful that nobody can take it anymore. And then we'll go down. That's how it works. That's how the machine works. Now, that said, there are periods in structural times when the risks are bigger. And we're entering one of those right after a 25% rip in the market over 2.5, 3 months, right?
Yep.
So, market up, vol up is a good sign that things are getting more dangerous. Don't play it just long or short. Play it with options. There's very cheap vol out there. If the vol is going to go up on the way up, right? Take that credit they're giving you. Take it. You're getting a chance to be long vol for close to no burn. Do it.
The window, I remember you said last time, if we don't get a big move around this Feb to March expiry, then it seems like that would be the market kind of taking a new leg higher, and then to not be even trying to fade really in any way. Where does that timeline end to where we kind of just go, all right, you know what, we have to let this beast ride until we see evidence of real material downside of people getting exhausted, to your point?
Yeah, so I want to be clear. Again, think 99, we knew that tech was overvalued, and the NASDAQ proceeded in 99 into the March 2000 top to rally almost 100%.
Yeah.
And then it dropped by 92%, I think was the final number. So anything is possible. If you want an exact period, right now you have about a week, a little bit less even, right, to start to see things falling apart. I would say about a week from now. If you don't get signs of that, right, the reality is those Vana and Charm flows are very big in the March Opex. When I talk about these big quarterly Opexes with all the open interest, the bigger the open interest, the probabilities of us going up increase as a percentage probability during those periods, but the fat left tail gets bigger.
Okay.
It becomes a distribution that is distributed with fat left tail. That doesn't mean the expected return changes. That means that the probabilities of an increase go up.
Right.
But the magnitude of the decline gets bigger on the downside. Why is that? All that open interest is gamma. If we decline into it, much like in that Feb to March OPEX cycle during COVID, it can explode and create a massive issue, right? But if it doesn't, if we continue to pass through time and vol begins to decline or at least consolidate, what's going to happen? All of that short stock that dealers have, they have to buy back.
Right.
And that just perpetuates a bigger and bigger squeeze into what's already got short interest and people betting against it. So yes, you could see a continuation, not just a continuation, a big push higher here into March OPEX if you get past this week. And there's no, it's a game of chicken right now.
Yeah.
Right? And so you can't just bet up or down. You got to bet where the probabilities are. That's why you want to own long dated calls. I want to say it again. Like, if this doesn't go down, it's going to go up, and it's going to go up big, right? We're going to squeeze higher, and there is short interest out there, and people are now getting squeezed out of that. There's an unpinning of all happening. The moves, just like you saw, we just did 100 points down the S&P and 100 points up.
That's what kind of looks like it's happening to the Russell today, because it seems like I feel we can pretty easily argue the fundamentals are the most precarious and dubious in the category of the Russell. To your point about the exposure to loans underwater, there's like 30% zombies in there. Even after the inflation print, the fact that the Russell's coming back as strong as it is, that to me seems like we're in that kind of squeeze mode in a way. We've got NVIDIA next week. What should we be looking for here?
Yeah, I mean, there's a trash dash component, right, that happens when these things kind of
start. That's what today feels like a little bit.
There's an added component I do want to add in. During OPEX right now, the NASDAQ is the place where all the customers have been buying calls and dealers have been short calls, right?
Okay.
That's because, again, that squeeze that they've been able to take advantage of. What's happened the last several days is as vol starts to decrease, right, in those calls, and we've had a slight underperformance, now those calls are decaying and the dealers are now having to sell out their stock. It's the opposite effect that we see in the S&P and broadly in markets. That, if you have that pressure and then the index is getting pushed up, what's going to happen? You're going to get a dispersion, and the Russell is now going to have to, or other entities are going to have to perform instead. So we're getting a dispersion trade, as we've seen. The S&P vol relatively is well contained. There's support in there, whereas on the NASDAQ, you're getting the opposite during this window. So I wouldn't read too much into it past this week.
Okay.
Right? If NVIDIA blows out earnings, could we see a continuation into the squeeze?
Absolutely.
If we think a market of vol up is going to continue, that would actually make sense. I actually think everything could go up on the next rally. It could be a real short squeeze.
Seems like that's what we're trying to push into, to bring everything else into the fold.
Correct.
Russell, Bitcoin, some of the deep value stuff, et cetera. So vol up, markets up, it's been happening. maybe a weekish left for the window of opportunity for weakness. The last point, which is macro, the 5% 10-year by the end of the year. I imagine you're feeling pretty good about that after the move, or is this give back here?
Yeah, no, 100%. Again, this is a secular view, right? We talked about this. We're getting continued signs of what we've been talking about for years. Everybody calls this a soft landing. In my book, it's not a soft landing. The cousin of soft landing is stagflation. We're getting a structural inflationary period as we start to see things really go into a massive slowdown at the same time. Everybody's confused now. How can we have this type of inflation but have kind of the commercial real estate issues and the slowdowns we're seeing across the board? Because they're not connected. Inflation is not just a cyclical component, as we've been looking at for the last 40 years. It is a structural rebalance that's happening from deglobalization, from populism, labor rights, all the things that we continue to talk about. And that will continue to be sticky. Not to mention, now oil's going higher, right? Those things are tied into those geopolitical disconnections, which don't necessarily have to do with the cyclical ups and downs of the economy. And so that is a very important point. Last thing I would say, the steepener, right? Everybody, we've been talking about this, would expect, because the last 40 years when rates go down, the whole curve shifts down, right? Mm-hmm. But we're not seeing that.
Yeah.
We're seeing the back end go higher. Why? Why is that? Because what happens if the Fed chooses in a stagflationary environment not to deal with inflation, not to be Volcker, but to be Burns, right? To really go favor GDP, and it's an election year. That's what's happening. They're favoring growth. If they're going to do that, in the short term, that means rates will come down. But what does that mean? That means we'll get a structurally more inflationary period. And ultimately, on the back end, they can lose control of the curve. And I think that's what the market's reading out from this. And that's why we're seeing this steepener. It's a stagflationary environment, and they're not being proactive with it. And that's a problem long term. In the short term, hey, blow off top can come. We can get a really positive election here. But watch out going forward.
All right. I like vol windows, Cem, but I also like macro, Cem. So I like the excitement. Great to catch up with you, sir.
Always great to be here. Thanks for having me.
Thanks very much. And a good follow-up to the analysis from last month. Cem Karsan, Senior Managing Partner at Volatility Advisors.